In this video today, we're going to talk about business valuations and how strong operations and a strong team can improve the value of your business. I'm going to give you some tips and recommendations on things you need to check on if you are preparing your business for a life-changing event like retirement, or you're thinking about selling in the future. There are more things to review than just looking at the numbers and saying, what's my business worth? We're going to take a deep dive into some of the things you can do to improve the value once you do get a valuation done. So first thing to talk about with valuations, I own a business brokerage and we do valuations for people. And I've noticed that there's quite a lot of off-market activity happening. So I speak to business owners quite frequently that they already have a buyer. It's someone that they know, they're in discussions with them, and they just want a quick back of the napkin type. Well, you can do this. There are free services online. You can do a quick Google search and you'll be able to plug in some numbers and it will give you a kind of a guesstimate. I was using a third-party service, and I actually stopped offering it for my clients because I just found that the numbers that were coming out weren't accurate. And I think to me, they seemed a little overinflated. And I could just see that being a problem when it came time to do an actual detailed, proper valuation, and the numbers would be off. I think it's better to be realistic upfront, but that's for a different conversation. Okay. You can get free valuations. Business brokers will do free valuations if you're planning on selling your business. That is a service that they provide. Just bear in mind, though, a lot of these free tools are prospecting tools for business brokers, for websites. So make sure that you still get a very detailed valuation, have all your paperwork ready, have all your financials ready. And if a business broker does a valuation for you, make sure that they thoroughly explain the results to you, okay, so that you understand what it is that you're looking at and where you can make changes. So with that being said, with the valuation part of it discussed in the sense of what people seem to be looking for, which is free, I would just say be mindful. So a couple of other things actually before I move on. If you're looking for a free valuation, but you already have a buyer for your business, and let's just say you both agree on a price and terms, and then you go through the due diligence process, and through that process, your buyer is planning on using an SBA lender. That lender is going to order an appraisal. So where you could have saved a few $1,000s up front, you could end up losing once you're further into the process, because if the bank comes back and says, we believe the business is worth this and this is all we're willing to lend you, Mr. Buyer, you'll then be in a discussion of probably having to hold a sizable seller note or drop your price, because the bank's going to lend what they believe the business is worth. I would say that saving the money up front, just know that you could be risking a lengthier transaction and then possibly things going a little sideways later on. If it was me, I would spend the money and I would get the valuation done. I would choose somebody very carefully. I would spend the money and I would get the valuation. If I was selling my business off market, okay. And then the other thing on that is don't scrimp on a lawyer either. I know lawyers can get very expensive, but if you are going to do this on your own, and let's just say you do get a light valuation, get yourself a lawyer, have an accountant ready, have the accountant help you with the numbers as well. Make sure that what you're giving to the business buyer is accurate. And then with regards to your paperwork, do not do it without a lawyer. I've seen, not that I get pushback when I talk to people that are selling the business themselves. It's just that I don't see them jumping at the opportunity of accepting an attorney referral. But it's going to save you money in the long run, and it's going to give you peace of mind post-closing, okay? There's a lot to get through when you're selling a business, even if you're just doing it by yourself. A lot. Okay, so with that little detailed lecture portion over, let's talk about let's talk about operations, let's talk about the team, and how you can make sure that your business is really solid, so that as you either speak with your buyer or you start to go through due diligence, you can really show that this is a solid company and it doesn't need me, the owner, because believe it or not, that's one of the one of the largest criteria that makes buyers very nervous is when the business is owner dependent. And a lot of owners will say that it isn't. Buyers don't see it that way, because if you have a buyer that is going to buy this business and come in on day one, they may not have industry experience, in which case they absolutely need a business that they can lean on when you walk out the door. Okay. Or unless you want to stay for an extended period of time. But I think even that sometimes doesn't work, because once the transaction's happened, the new owner wants to just roll their sleeves up and get to work. And you being there could be, even though it seems like a really good idea when you're going through the due diligence process and the selling process, it can be, they just can want to move on. Sometimes it's not what business owners are expecting, the seller, but it happens to where the buyer just, yeah, I know I've got all of this time available, but I just want to get on with it and run the business. That's just something else to consider. Okay. And that's why these notes that I'm going to go through with you are so important. Okay. So we've gone through valuation. The first point I want to go over with you is sales. So are your sales relational or are they transactional? So if they're relational, are they built on ongoing relationships with customers? Do you have recurring business? Do you have recurring revenue? If you do have recurring business, what does that look like? Are you subscription based, or are you more of a retainer based, or do you bill every week for work and you just have ongoing contract work with your client? So being clear about that and having written documentation of that. Hopefully you've got QuickBooks and all of your clients are in there. That's great. Just making sure that you have notes on all your clients. If you have contracts, make sure that those contracts are assignable to a new business owner, because if you sell the business and they're not, then they're null and void, and that new owner will have to negotiate. And more than that, it just doesn't create value. Okay. So in this discussion, I want to talk about what's going to make rock solid value in your business. So relational sales, very important. Recurring sales, very important. Subscription, obviously, is fantastic. But from my previous experience in the world of business that I've been in, personally running a business, my sales were relational and they were contract. And that brings me to another point, making sure that one customer, even though it's contract work and it's recurring and it's nice revenue, make sure that one customer doesn't have too much concentration. That's a big risk. What it's going to look like is a nice, evenly split up. You can print a report that says jobs by customer or sales by customer, and it should be evenly distributed out amongst many customers so that there's no risk there. If one customer drops off, it's no big deal. It doesn't cause a dent in the revenue or the profitability. Okay, so that's what's going to make your business look really strong. So annually, you would want to be going through your customer list and making sure that you're not getting too heavy with one customer. As they get happier, become happier and order more and more work, that can actually end up being a negative. So the positive is good amount of customers spread out. The next thing is, profit margins. Okay, so how are the profit margins? Can they be improved? Do you look at your expenses annually? Do you try to make sure that you're not wasting money? Do you do an audit? Do you have your CFO or your accountant going through the books with you? When you do your itemized, your annual, there's always that line item that is, the accountant comes back to you and says, what's this for? There's one where they bundle all of the expenses that they don't know exactly what they're for. So at some point during the year, you're going through all the expenses, you're going through the financials, and you're looking at everything. So how are the profits? Can they be improved? If your profit margins are good and they've been good year over year, if your profits are steady or increasing, that creates a very nice, solid foundation for you. Even if profits are creeping down slowly, that's going to create a question for a buyer, and it's going to leave you vulnerable to them wanting to negotiate down the price. The next thing that I made, so these are all my notes that I'm going through. So the next thing that I want to comment on is liability. So do you have the right insurance in place? Obviously, Some businesses have a lot more liability than others. If you're in construction, if you're in some type of labor where people go out in the field and they do jobs, you're going to have a larger liability. If you work and this from my previous experience, if you work anywhere near the ocean or the water and you work on vessels, on ships or over 65 feet, you will need what's called longshore insurance, and it is very expensive and you have to have it. There's no workaround. So making sure that you have, and it's funny because when I ran an engineering company, so many people told me in the beginning when I started the business, I co-founded it, they told me, just don't worry about it. Just file an exemption, or it's just because it's so expensive that when you're first starting out, it's it almost makes you want to cry. And the more people you get, the more expensive. You just keep adding on the amount needed. But you've got to have it because if they're on that vessel and they get hurt and it's over 65 feet, you're going to get into trouble, but it's too much risk. That was a long-winded explanation on liability, but do you have the right insurance in place for the team? Are the team properly set up? So what I mean by that is, okay, let's think about this. We're looking at this from the lens of what makes this business really desirable. Okay, we know we've got the revenue. We know we've got the cash flow. Great. And these are all the other things that if you look at these as you get ready for a sale, and let's say you're thinking 3 to 5 years, or you're building out your business to get ready for an exit, even in 10 years. But I'm thinking with the people I want to speak to, it's probably going to be, you're going to be between the age of 50 and 60, or you're already going to be at retirement age. This is going to be more for the people that have a little bit more runway and want to build out the business and make changes. Or for those of you that can look at the business and check these boxes, you will know that when you do get your valuation done, this all has to be taken into consideration because it's really good stuff. It's like having a house built on a solid foundation. Are your employees set up properly? We just talked about insurance. Do you have them set up as W-2 employees, not 1099? And if they are surely 1099, so I have worked with 1099 contractors before. Remember, they're not employees. Are you properly qualifying them? Are they able to do the work unsupervised? Do they bring specialized knowledge to the business? Do they set their own hours and their own work schedule? They should not be directed by somebody at your company. Okay. So those are your 1099s. Those are your contractors, your subcontractors. Oh, and another point, back to liability and insurance, if you have subcontractors in certain businesses, like I'm just talking about the ship repair business, we had to make sure that even those subcontractors met certain standards to be able, and we would have to report them to our insurance company. Okay. So when you're in the weeds on all these details and you've got everything checked, you're good. Okay. So back to the employees, 1099 versus W-2. Okay. Good. Now we know that all of our regular employees that work in the business under our direction, hourly employees as well, have to be handled differently than salaried employees. Salaried employees have different qualifications. So let's just assume that everybody's hourly, right? Great. You've got them all W-2. Are you tracking their time? Are you paying them overtime? I met somebody and he was a business owner and we were talking about his business as we're doing here. And he had some very creative method for paying employees for their overtime. I think he essentially paid them a flat rate and allowed them to, I don't know if you even remember what it was. He allowed them to just report their overtime or receive a bonus. I don't know what it was, but they were working over 40 hours a week sometimes, and he was not paying them overtime. So these are the things that actually, if you're doing this properly and you're setting your employees up properly and you're tracking their hours and you're paying them for overtime, it's great, right? Because you can show this. You can show Mr. Buyer, Mrs. Buyer, this is how my business runs. Because if there's going to be, when you go through due diligence, there's going to be financial due diligence, there's going to be legal due diligence, and there's going to be operational due diligence, and then there's going to be HR as well. And these are big parts of your business. Next thing is, are you OSHA compliant? Or if you have some other type of standardized safety measures that are needed, are you compliant in those? Do you document things? Do you have safety training in place? Do you have OSHA training in place if needed? If you do, this is going to be fantastic, and it should be documented, and it should be available to show a buyer, just as it would be available to show somebody if you were to get an OSHA complaint or to have some type of safety inspection. You have insurance inspections too, so those can keep you on your toes. They're not that detailed, but it's a good way to get the team, okay, we need to make sure we're doing these things. And an annual insurance inspection is a good one also for making sure that everybody's on board. So 1099 W-2. Oh, and so with regards to how you set your employees up, something else that you should be looking at as you start to look at the strength of your company operationally is for the W-2s, do you have only part-time staff because you only need part-time people? And then why do you have so many of them? If this is something that you can see in your operation, ask yourself that question. Do you have the part-timers because you want to avoid paying benefits, meaning sick, holiday, PTO? Or is it just because it genuinely is a business that operates off part-time staff? And the reason that's important is that if you're not paying the proper benefit, if you just have, and not just have part-time people, but if you only have part-time people on your payroll, a buyer is going to catch that. And what that's going to do negatively is the buyer is going to, I'm not going to run a business with 10 part-time people. I'm going to have 5 full-time people. And because I want to do training, I want to do employee development, I want to be able to promote, and I just want to have a different culture, right? Maybe they just want to have a full-time team. They are then going to have to go in and account for the increase in employee benefits. So that's going to decrease the value of the business, or not decrease the value of the business, but decrease the profitability, right? Which will, in a regular snapshot, it will decrease the value of the business because the profitability drives the value. So that's something that you do want to look at honestly. But if you have your business set up in such a way that, I know for me, I was just shy of 50 people when I ran an engineering business, and I always say we had 50, but we had 49, and that just kept us at a level that we needed to be at. Some of the rules changed after 50, and those rules didn't change for us. But I had all full-time employees, and I think I had 2 part-timers, and the part-time people were the recruitment team because I didn't feel that we needed full-time recruiters. I felt like we could leverage part-time people because I needed people to come in on Saturdays and in the evenings because we had to recruit all the time. So in that situation, those part-time staff were really, they needed to be part-time because we needed flexibility. So that is something else you should look at when you're doing an assessment of your business and how strong it is, along with your valuation, to be able to put a great package together for your buyer. Next item that you would want to look at is owner salary. How many jobs are you actually doing? I know that we are all guilty of doing really more than we're being paid to do. That comes with the territory. But it's time now to sit down and look at the salaries. How many jobs are you doing? And what will it cost to replace you? And how many jobs need to be filled to replace you? So will the new owner need a general manager? And here's a side note. To be completely honest with you, most business buyers do not want to buy a job. And especially even if they're coming in to have the business, to be involved with the business, most of the buyers that we speak to, they have no interest in having a job, and that actually puts them off. If you are in a position where you pay yourself a salary for the work that you do, and that salary is at fair market value, so what's it going to cost to replace you? And then if you have all the other team members in place and their salaries are at fair market value, not above or below, because that's going to then cause the buyer to need to adjust your numbers. So an ideal world for a good business is Mr. or Mrs. Owner are doing this work, you're compensated this much money. Maybe you also have some type of distribution if the business has a really good year, but for the job that you do in business, you are paid a fair market salary. And all the other people are paid fair market salaries. I'll give you an example of a business that I spoke to the owner and they were paying themselves, maybe they were paying themselves 30,000 a year. Okay. And I asked them for the role that they were doing, which was a licensed professional role, how much would it cost to place them? And they told me 45,000. We have the internet now. You can do research on Glassdoor. You can do research on Indeed for salaries. And in doing the research, it was actually going to be 75,000 to replace her, to get a full-time person to do the job that they were doing. So that obviously throws the numbers off, because the new owner they're going to have to account for that. So just as there may be expenses that will go away when you leave, like if you're running your personal vehicle through the business, or maybe you pay a family member full-time and they only work part-time, just as those expenses will go away, new expenses will be introduced if you have artificially suppressed expenses. That's the best way of putting it. Okay. So we've covered salaries. How much will it cost to replace you? We covered that. The team. Okay. Another great thing to look at with your team is, are they cross-trained? And do you have any formal processes in place? Do you have SOPs, standard operating procedures? So many small business owners don't know that term, but we can just call them processes for now. So hiring processes, do you have training processes? We talked about safety training. Do you have cross-training processes? And also a really good thing, a good idea for cross-training is it also puts checks and balances in place. If somebody goes on vacation, instead of just holding their spot and having them catch up on the work when they get back, have somebody else cross-trained to do that role, because sometimes things are happening in your business that you're not going to know about. Things like shrinkage, things like inventory, maybe excess inventory being ordered. I know shops, blue collar businesses, things going missing is just, it's a big deal and it's really hard to manage. Having employees cross-trained where they can go in and cover each other when they're on vacation, it does two things. It stops you from panicking if somebody wants to take a vacation, because you're not so dependent on that one person. In some specialized roles, that may be a little bit harder, but even if you cross-train a more junior employee, that's great exposure for them. And it's just great training and it's great for morale. And it contributes to that good foundation that your business has. So processes, procedures, do you have training in place? I know that stuff probably makes you want to, the thought of it, pull your hair out, but this is what makes really good businesses, right? So if you're listening to this and you're speeding it up a little bit because you have all of this, then that's fantastic. You're going to be in a really strong position when you get ready to talk to your buyer. Next thing I wanted to mention is, how many family members are on your team? This is something I've come across in one particular sector. I've come across it in the funeral. I've done some work in the funeral services sector with business owners, and these are extremely family-oriented businesses. That wasn't really a proper sentence, was it? But I actually came across a business once, and I didn't realize until later, but every single person except for one employee was related to the owner. And there were probably about 12 people working in the business. Everybody was related to the owner. It doesn't take a genius to figure out why that's a problem. The owner wants to sell and the owner wants to exit. Everybody's used to working for the owner, who's their family member. These people have all grown up together. They have a completely different dynamic from a business where a new owner is going to come in. You don't know them, or they don't know you rather. They don't know the new owner, and the new owner probably wants to have more of a straightforward business culture. And that's going to be a problem. They're going to have a mutiny on their hands. So how many family members are on your team, and while obviously you're going to keep your family in place, if you have an equal amount of other employees, that's where you could cross-train them. If you have a really good cross-training process in place and you have everything documented, that could counteract some of the risk that a buyer would see in that situation. Okay, so that's my kind of tip for that one. Next thing that you will want to take a look at as you're assessing the strength of your business in line with having a valuation done or however you go about that is vendors. Are they being competitive? Do you check on this annually? Who checks on it? Who checks on their pricing? Does your team continue to shop around or do you just stick with the same old vendors? A good annual audit of your vendors is a great idea. Make sure that they are servicing you properly, making sure that their prices are competitive, and it certainly doesn't hurt. I mean, there's loyalty to your vendors, of course, but it certainly doesn't hurt every year to do an annual audit of your vendors. So that summarizes all things that I think you should check into. And if you have all of that in place, I think that you've got a strong business. And if you don't have it in place, now you have some. I'll put a link in the show notes, some information that you can read up on. And I'd be happy to help you if you have questions. Just reach out to me. There are services. One of the things that we do as an accredited small business consultancy is that we actually do run these types of audit. I work under the methodology of the Association of Accredited Small Business Consultants. So while we are a business brokerage, one of the things that I think would be really beneficial to some business owners, if you have some time, if you're looking 3 to 5 years out, is to have a consultant take a look at everything and give you some pointers and maybe even do a SWOT analysis for you. That would be a great idea. That's what I'll do. I'll put a link in the notes to SWOT analysis and how you can do one to see where you're really at. Strengths, weaknesses, opportunities, threats is what that stands for. So happy valuation document gathering if that's what you're doing next. And reach out to me if you have any questions about any of this stuff. I love this and I know that a lot of businesses struggle with it. So I'd be happy to help if you want to reach out.